Welcome back to Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. We're pleased to welcome David Malpass on the show to talk global political economics. David is the president of Encima Global, former chief economist at Bear Stearns, one of my favorite talking heads whose columns appear in Forbes and the Wall Street Journal, and an old policy hand going all the way back to the Reagan administration. David, welcome to the show.
Thanks, Bill. Nice to be on.
David, as the Chinese curse says, we live in interesting times. Is there a spot in history where the world's monetary system has ever been so trapped in such an unsustainable trajectory?
Well, these are tough times, but if you think about the 1970s, that was a huge challenge for monetary policy. Remember, inflation in the U.S. got above 15%, so that's pretty impressive.
But are we on a course that seems to be doubling down every quarter with the way global monetary authorities seem to be printing money?
Yeah, I think in our current environment, they're really on the wrong track. So I was only making the point that it's not as bad as the 1970s of high inflation. What we're doing right now is this giant intervention by central banks in the free market economy. The Federal Reserve, the European Central Bank, and the Bank of Japan have been buying giant quantities of bonds. That's unprecedented. That's not part of normal monetary policy. And they have the interest rate set at zero, or in the case of Europe, negative. These are really harmful policies, and the results are pretty clear. You've got slow growth in the U.S., in Europe, and in Japan, and in many parts of the world, a recession underway, even though the central banks say they're trying to be stimulative.
Well, you know, those of us who are not economists scratch our heads, and we look at what has been called money printing with all this QE all over the world, and we ask ourselves, where did all that money go?
Yeah, you know, I've been trying to persuade people for 4 years now that there hasn't been a single dollar printed or euro printed or yen printed. And they scratch their heads and say, how could that be? They bought all these bonds. Right. But remember what the central banks are doing. When they buy a bond, they only buy it from their own primary dealers. Those are the special banks that have a special relationship. And they never pay them cash. What they pay with is an accounts payable that's held at the central bank. So there's really no money that's put into the private sector. So all that's really happening is the central banks are beefing up both their assets, which are the bonds that they're buying, but also their liabilities. They still owe all of that money to the private sector. So there's no money printing at all, and you see the results. There hasn't been any inflationary impact from these activities.
So why do they call it stimulative if they're not pushing money into the economy?
From the beginning, Ben Bernanke, the former chairman of the Fed, explained that the only mechanism, the transmission, was that they were lowering the long-term bond yields. So that's what the Fed is buying. They buy long-term government bonds, and that pushes up the price of the bond, and that pushes the yield of the bond lower. So that the yield on the U.S. 10-year Treasury bond has been going down and down. My complaint with that is by buying that particular type of asset, it only helps the people who have that kind of asset. That means wealthy people who own bonds already, they get a benefit, or companies that can issue long-term bonds, like a 10-year bond. That's not your average Joe. That's not small businesses.
Yeah, not startups.
That's really only the government and big corporations. And so they're getting all the benefit, and that shows up in all the data, that the rich are getting richer, and the median income in the U.S. just kept falling through the recovery. The real median income kept going down during the recovery.
Aren't we also making it easier for profligate governments to borrow and then piss away the money?
Yeah, this is a giant problem, that if you're the federal government, you're sitting there saying, golly, the Fed is going to buy my long-term bonds. And so that takes away the discipline of the market. So the government was able to spend huge amounts. Well, in fact, the data just came out where the Fed showed over the last 5 years, I happen to have it here, the government borrowed or added to its debt by $5.2 trillion, while the private sector only added $1.8 trillion to its debt. So if we look over the last 5 years, a giant amount of the credit, the available money for spending, went to the government, and indeed it went ahead and spent the money, and the economy didn't get much for that.
How is this money all going to get paid back?
Okay, let's divide that into two parts. The government debt itself is often long-term debt, and it's going to get paid back by children and grandchildren. And so that's, really this generational transfer where we spend the money now and then somebody has to pay it back later. Now, liberals look at it and say, no, when we get there 30 years from now, we're just going to roll it over, so we're never going to pay that debt. That's really nonsense. The burden is on the economy when you overspend in the current, because the private sector knows that someday it's going to be taxed for the interest on the debt, even if it gets perpetually rolled over. The second type of debt is the debt that's at the Fed. So remember, the Fed has now borrowed $2.8 trillion from banks, from the U.S. and global banking system, in order to buy U.S. government bonds. And so I think over time that will probably be made good. Certainly it will be made good. But what it's doing is concentrating power within the Federal Reserve, which I think has its own damage.
If we ever audit the Federal Reserve, as Rand Paul is promoting, what do you think we'll find?
The audits accomplish different purposes. So one of the things that an audit would do of the Fed is simply begin to give the public confidence that there's not something amiss. The public is justified in saying, what have you now have $4.5 trillion of assets. You've turned yourself into this gigantic money manager. Are you sure you know what you're doing? And so one question an audit could answer is, does the Fed know what it's doing in managing this giant bond portfolio, one of the world's biggest bond portfolios? I think there are a lot of detailed questions that occur right now. The Fed, as I explained, is borrowing this huge amount of money from banks, and they're paying the banks interest of 25 basis points right now. So one of the questions an audit could answer is, how did you decide to pay the banks, and are you planning to pay them more? The Fed is saying that it's planning to raise interest rates and that they're going to double the amount that they pay to the banks, going from 25 basis points up to 50 basis points. That's 0.5% interest over a 1-year period. So it's not an exorbitant amount. But when you apply it to $2.8 trillion of the Fed's liabilities,
yeah, it adds up.
And so the question is, how did they decide to pay this to the banks? Were there some cheaper alternatives? For example, could the Fed be borrowing from non-banks? That means other parts of the U.S. financial system, rather than just borrowing from the banks the way they are now.
Looking at what mechanisms the Fed has for changing interest rates, I've been watching them experiment with their reverse repo facility, which looks to my untrained eye like a mechanism to turn them from a lender of last resort into a borrower of first resort. What's really going on there?
Central banks have a really important purpose, which is as the lender of last resort. So if a bank takes deposits from people and then gets into trouble, you need to have some kind of a backstop system. And that, I think, is an appropriate role for the central bank. And it's been unfortunate that the Fed now has expanded into so many other areas. So under the current policy, they've done what's called quantitative easing. That's QE, where the Fed has bought an enormous amount of bonds, $4.5 trillion worth of bonds. And they're right now financing most of it from commercial banks. The alternative source is reverse repos. And so all it really is a recognition that the Fed has become just a giant balance sheet, something like a sovereign wealth fund that some countries have. And it's a very dangerous concept, I think, in our free market system, because it's part of the U.S. government that's managing a giant portfolio. My own view is that it would be cheaper for the Fed to borrow through the repo market rather than to be borrowing from banks. They're paying really top dollar to the banking system for the borrowed funds. What
is all this central bank intervention doing to price discovery in both our bond and equity markets, and what are the implications?
As the Fed has expanded its role, what they're doing is sitting right on top of a free market economy and really changing the way the market operates. The starting point for that is setting the interest rate as they're doing at 0%. That really distorts the market's ability to lend. For example, it used to be that U.S. banks would lend to each other. But if the interest rate is 0, why would one bank lend to another bank? And so banks that have extra cash just sit on it, and banks that are short of cash, meaning they've got some good loans to make to maybe a small business in their community, it's hard for them to get funds under the current system. So the Fed, by doing its policies, has been causing that distortion at the short end of the interest rate market. And then in addition, the Fed is buying these long-term bonds. And so that's completely changed the pricing of long-term bonds. In this case, it benefits people who can either own long-term bonds, mostly wealthy people, pension funds perhaps. And it also means that big companies and the government can borrow more cheaply than they otherwise would be able to do. But that comes at a massive cost. It means that smaller businesses that maybe want to borrow short-term money, a new business, for example, can only get a 3-year loan, let's say. That money is simply not as available in the economy as it otherwise would be.
So, David, if they gave you Janet Yellen's job running the Fed tomorrow, what would you do?
Well, I think the Fed could be more pro-growth than it is in its current incarnation. And so one of the things the Fed, I think, should do is explain that the zero interest rates is not the ideal for the economy. There needs to be some interest rate in order to make it worthwhile for savers, for example. And so the Fed could explain that and then begin to move more expeditiously toward that first small rate hike. It's not going to hurt anyone on the negative side, and I think it would make markets work better.
So let's get on with it.
From a philosophical standpoint, the Fed, I think, and I've written, that could be more modest. The Fed right now is making these economic projections for the economy. They make all of this push on themselves to create growth in the economy. And I think the Fed has to explain to the U.S. government that it can't create growth. At its best, it can provide sound money for the economy and let the rest of government do its job. And the Fed's taken on much too many roles. Inside the Fed, there's something called the CFPB, the Consumer Finance Protection Bureau, which is a giant new organization sitting inside the Fed. And I think the Fed should push back on that and tell Congress, look, this is not the role you intended for the central bank. And a final thing I'll mention is simply the Fed has to give us a resolution to its giant portfolio. The Fed has no business owning $4.5 trillion complex portfolio of bonds and mortgage securities, which they do now. And so they should plot a course to allowing that asset pool to diminish in a relatively short period of years.
So the European Central Bank is about to go on a major bender to save the euro. If they kicked out Mario Draghi and gave you the president's job there, what would you do?
The European Central Bank is in a really difficult situation because the governments of Europe really don't want to change. They're all too big. One of the problems facing Greece is just that the government itself has too many people on the payroll. They have a big military, for example, that they just haven't been willing to scale back. And so they're bleeding cash, which is now a burden that's been taken on by the ECB. I think the European Central Bank has to say to the governments that it can't create growth, that you can't create growth by buying bonds around Europe, for example. The ECB last summer said it was going to help Europe by buying certain types of exotic instruments, covered bonds issued by banks and asset-backed securities, and then they were not able to accomplish it. It was a flop. And so the ECB is at risk now because they've made pretty big promises about the positive effects of their bond buying program that started up in February. And I think they should downsize expectations, put more of the burden on the governments. You know, Draghi has this great phrase that he's used before that what governments need to do is spend less and tax less. So this is a little different twist from the austerity. You hear a lot about austerity, but he's saying do less of both. Meaning less spending, less taxes. I think that's a great recipe, and he should kind of hammer that home for all the governments. Italy needs to do that. Germany needs to do that. Their government is gigantic, and they don't want to talk about it, but they really should talk about spending less and also taxing less. And what you'd get is more freedom, more growth, more investment. Business investment is lacking in Europe under the current system, so you'd get more of that as well.
Let me make it more challenging. If they gave you Alexis Tsipras' job as Prime Minister of Greece, what would you do?
Yeah, Greece is a tough one. But, I'm an optimist. I think countries around the world are able to grow, and we've seen dramatic transformations in countries. If you look at Brazil, for example, in 2002, 2001, people thought it was, gone, that it couldn't recover. And then a new president came in, President Lula. He was from the Labor Party, so he was a leftist, but he began making good choices for Brazil, and Brazil's growth picked up, and the country did well. So in the case of Greece, I think every day the prime minister should make good choices about ways to have the government spend. You've got to start with the government and say it should spend less money. And that means less limousines for government officials, some limit on the pensions that are paid to government workers. In the case of Greece, it's very important to downsize the military, or at least not keep expanding the amount of equipment within the military. Those are not going to be popular among certain parts of the political spectrum within Greece. Another huge challenge for them is to be willing to sell some of the government's assets.
Right.
The government of Greece, like many in the U.S., is sitting on some prime properties. That means marinas, airports, port facilities that are quite saleable and that would help create jobs if they were in the private sector. And a final point for Tsipras in Greece is they have to find a way to bring down the value-added tax. They charge on every transaction. The government, the federal government, gets 23% of every transaction in the economy.
That's ugly.
And that means much of the economy is underground because people simply can't pay that much to the government. And so they've got to find a way to cut government spending and government taxes enough to get growth going.
David, you say you're an optimist, and you must be. Whatever possessed you to run for public office back in 2010?
Yeah, I ran in the Republican primary for Senate in New York State. There seemed to be a political opportunity in that there was a transition. Hillary Clinton's term had begun in 2009, and she'd been replaced when she went to be Secretary of State by Kirsten Gillibrand, who was a congressman and not well known across the state. So there was an opportunity there. And then above all, I had a message that I wanted to bring out, which is that New York State could grow faster with better policies. New York State has a big, hard challenge, which is that people are leaving upstate. The state's politics are often dominated by New York City, which benefits from the financial industry, but that leaves many parts of the state really being depopulated because there aren't jobs. Property values are going down instead of up. And so there needs to be, I think, a bunch of new policies that would help New York State. So that's what I campaigned on. I traveled around the state and didn't win in the Republican primary. And so that was my political career.
So I had a chance to go to CPAC, the Conservative Political Action Conference, last month. I saw quite a bit of ferment inside the party. Is there an opportunity for the Republican Party to remake itself?
Well, I hope it does. In Europe, what we're seeing is this anti-establishment movement from both the right and from the left. People are saying our government doesn't really represent us. And I certainly think that's the case in the U.S. So the Republican Party needs to really grab that opportunity and say, we are the party of the people, and we want to see more private sector. And it's going to be necessary within that in order to have a more vibrant private sector and more freedom. You're going to need to find a way to restrain the power and size of the federal government.
Mm-hmm.
I think that's what's missing in our current mix. We're seeing it in the Federal Reserve, which we were talking about earlier, that it keeps growing, just keeps getting bigger and bigger and more powerful, dominating the regulatory process. So that's one area that needs to be restrained.
Mm-hmm.
I think it goes throughout the budget system within the U.S. that we never really have a top-line budget, and so Washington doesn't tend to make choices on how to spend money. They just say, well, let's do both. Let's do this expansion and this expansion, and that goes on and on. You know, there's a good opportunity coming up this summer. The Export-Import Bank is going to be up for renewal of its authorization, and I think that becomes a symbolic choice. We have to find a way to say that the government should do the things that are necessary for the well-being of the country, meaning national security and many other things. The government has a positive role to play. But in areas where it's not necessary, for example, export financing, then we don't need the federal government to do it. Let's let the private sector do that.
So, David, you've talked about trying to restrain the growth of government. We are coming up to another debt limit debate right now. How do you handicap that?
Yeah, this has been a problem for Republicans. You know, the core of the problem is we have a debt limit law on the books, but it's really a fatally flawed law. The spending occurs, and then you have to raise the debt limit in order to accommodate the past spending. So the opportunity, I think, for Republicans is to say to the president, let's talk about this. We as a nation need a budgeting process. This is a vehicle. And then if the president doesn't want to do that, which right now has been his normal response to things, then the Democrats can vote for more debt. If they want to do that over and over again, it makes clear the divide between the parties. So the opportunity here is that the debt limit is a law that the president's going to have to sign. And so it gives a chance for the people, the public in the country, to speak to Washington and say, look, we need a better system of limiting the checks and balances within Washington, and we want both parties to work together on that.
So maybe the last chance to put on the brakes.
I think it may be the last chance to put on the brakes. Well, we've seen that every 1 or 2 years, the Republicans get themselves cornered into having to support the increase in more debt. I think there's an opportunity to say, look, if the president wants that, then the Democrats can vote it, and then we're going to have an election.
And in that case, the American people will choose. David, thanks so much for being on the show.
Thank you, Bill.
That was David Malpass, president of Encima Global, here on Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. Real Clear Radio Hour is produced in conjunction with Real Clear Politics, America's premier independent political website. If you'd like to hear more, stop by realclearradio.org and sign up for updates on our weekly broadcasts or access podcasts of our past programs. That wraps up our show for this week. Join us next week, same time, same station. See you then.